All right, hello again. This is Mike with the Netpicks Inner Circle. In this week's options trade of the week, we're going to take a look at selling a put spread on JP Morgan. I'll walk you through how I'm piecing this trade together, the thought process behind the trade, walk through the pricing that we can collect to put this trade on, and then we'll walk you through how to manage this trade from start to finish. But let's start out by talking through the thought process behind this trade. In front of you, you're looking at a daily chart of SPY, the S&P 500 ETF. The reason I bring this up, we saw a pretty significant test of some support levels yesterday. Those were the 200 period simple and exponential moving averages. They tend to act as very strong areas of support and resistance. In this case, a very strong area of support. We've already tested those levels a couple of different times here so far this year. The first time back in February, the second time in late March, early April. And both times that we tested those levels, look what happened afterwards. Led to some pretty significant rallies. So the test yesterday, it happened on bigger volume. We tried to probe below those levels intraday, but by the close, we had already rallied right back up, and the bulls defended those levels really well. Here today, as I'm recording this video, you can see the Dow is up almost 300 points, the Nasdaq's up 100, and the S&P is up 27. So there's, again, a significant defense of those support levels going on. I believe that could continue going into next week. I'm not saying to this extent. I'm not saying the Dow is going to be up 300 points every day, but I do think we're going to get back into a bullish stretch here over the next couple of weeks. So I wanted to take a look at some of the names that could potentially lead the charge. And with interest rates at everybody's forefront, everybody's talking about interest rates. They are continuing to move higher, with the Fed raising rates. The financials are going to benefit from that. And I think the financials are such a big part of this market. If this thing is going to head higher, the financials are going to at least have to participate. I'm not saying they have to lead the charge, but they do need to participate in the move to the upside. And looking at JP Morgan, you can see at least in the near term, we'd seen a nice little move to the downside. This isn't the cleanest pattern. We're not significantly oversold here. So that's why I don't want to just come in and buy a call or buy a call spread. I'm not super convinced that that's going to happen to the upside immediately. So by selling a put spread, it gives us a little bit more leeway. We don't need the move to be big to the upside. We don't need to have it happen immediately. We've got the benefit of time decay working in our favor. So again, on this chart, I'm not necessarily looking for a specific chart pattern. I'm not looking for a specific candlestick pattern. I'm strictly looking to determine if I want to be bullish, bearish, or neutral. And based on my outlook, I'd like to be neutral to slightly bullish. So I'm going to go over to the trade page. And let me just shrink this down for a quick second. So let's go ahead and take a look at the Ivey Percentile. The only issue that I have with this trade, the Ivey Percentile is only at 34. The volatility in the JP Morgan options, it's pretty low. And when that happens, the premiums are not as rich as I would like. So it's not a deal breaker, but what happens there is when the volatility is low, and what I consider low, if you have an Ivey Percentile below 40 like it is now, you're going to find that the options are a little bit cheaper. In order for us to put on a trade by selling a spread, we're probably going to have to move the short strike closer to the current stock price. When we do that, we don't give ourselves as much wiggle room to be wrong. So again, while not a deal breaker, it's just something that we do need to be aware of. Now, I also need to talk about what expiration cycle do I want to go with. Right, we've got a number of different weekly cycles that are shown in yellow here on the trade page, and then we've got the May monthlies with 14 days left, and the June options, the June monthlies with 42 days left. So what route do I want to go? Well, I don't have a problem trading the weeklies as long as they have good liquidity. I'm not really interested in taking a look at the weekly options next week. Not really interested in the May monthlies. There's just not enough time there. For this type of a trade, with this type of an outlook, ideally I'd like to find 20 to 40 days left to expiration. So I went and took a look at the May 25th weekly options. They have 21 days left. And I took a look, I opened those up and I said, okay, I want to sell a junkie out of the money put spread because in doing so, it's going to leave me with a bullish position with a neutral kicker. Meaning if we don't get a quick pop to the upside, I can still make money from the time decay adding up. If the move just continues to go sideways, if we start to consolidate and chop, I can still make money from that. So I came to the out of the money puts here, and I took a look with the price, with the stock price currently right around 108. I went to the 107 puts. Okay, so I right-clicked on them. I went to sell and I went to vertical, and it popped up an order down at the bottom where I'm selling the 107 put and I'm buying the 106 put to make this a fully risk-defined trade. Right now it's trading for 34 cents mid-price. If I hit confirm and send, let's break this trade down in a little bit more detail. If I'm selling the 107 put, I'm collecting premium for that put option. I'm also coming in and buying the 106 put to make it a risk-defined trade. If all I did is sell the 107 put, it's going to tie up a lot of capital. It's going to leave me with a lot of risk, and I don't feel comfortable with that in this type of an environment. Just in case I'm wrong, I'd like to know what my maximum loss is up front. I think in this type of volatile market that we've seen here over the past couple of months, being in a risk-defined trade is certainly the smart route to go in my opinion. All right, so it puts my break-even point at 106.66, and that's calculated by taking my short 107 put. We subtract the 34 cents that we collected to put the trade on, and that gives me that break-even point. As long as JP Morgan stays above that level, even if it's by a penny, I can make money. So if it closes at 106.67, I can make money. If it closes at 115, if we get a massive rally upcoming, I can make money. If it moves dead sideways, it's just slightly lower, I'm okay there too. So I've got 3 ways of making money there. I also make money if time decay adds up and if volatility decreases. So I've got 5 different ways of making money on this trade. Now, if I collect 34 cents to put this trade on, that's the most I can make on the trade, regardless of the outcome. If we get a massive rally, my profit potential is capped at $34 per spread. The best part about this trade in my mind is I'm only risking $66 to put this trade on to begin with. $66 per spread. So if you put it on one time and you're dead wrong, you're out $66. That's the worst case scenario. So it's a very manageable trade regardless of your account size. Now I'll put this on multiple times. I'll put it on with multiple contracts. We could put this thing on with 20 different spreads and you're still talking about, $1,200 to $1,400 of risk. So it's a very manageable type of a position. So you're looking at that saying, okay, the most you can make is $34. Doesn't seem like a big profit potential. Well, you start to put it on 20 times, and all of a sudden you're talking about, $700 of profit? $700 of profit here over the next 21 days, and I don't need to have a big move to the upside. It's a great way to generate some income. So that's why I really like the profile of this trade. Now we're right around a risk 2 to make 1 scenario. Why am I willing to accept that type of a ratio? Well, I'm willing to risk more to make less here because I have 5 ways of making money. When you buy a call or a put, you really want to make sure your winners are larger than your losers because you don't have as high of a winning percentage. You really need to have everything line up perfectly in your favor to make money. In this case, because I have 5 ways of making money, which we just outlined, I'm willing to sacrifice my risk to reward scenario. I know I've got a very high probability of success, so I don't mind that I'm risking more to make less. Right? So really great trade profile. Really like the way this one is setting up, especially if this market continues to make a grind to the upside over the next few weeks. Now, how do we manage this trade? Let's say we get filled at 34 cents. My initial target zone is 50 to 75% of my maximum profit potential. So 50 to 75% of whatever I collect to put this trade on. So if I collect 34 cents, if I can buy this thing back for between 8 and 17 cents, that would be an ideal zone. Now, you don't have to immediately close it out when you hit that 50% number. That's just the first time that I can come in and reevaluate the trade. Do I want to hold on longer? Has my outlook changed? If it's changed, if the market's really starting to, to show some signs of rolling over at that point, and I'm not as convinced of the bullish outlook, I could go ahead and book the partial profit and move on to the next trade. If I hit that 50% number and I still like the position, I still think the market's moving higher, everything's looking great on the upside, I could hold on a little bit longer and target that 75% of maximum profit number. So the only time I can book the full $34 is if I hold to expiration, which I'm not necessarily opposed to doing. I just don't do it all that often. Because the closer we get to expiration, the faster those options react to changes in stock price. So you could go from a full profit, let's just say you've got a really nice profit over the next 15 days, then you decide to hold to expiration, and during the last 6 days, all of a sudden the market reverses and you go from a nice profit to a full loss. I don't want to run that risk. I would much rather book the profit when I can, not have to mess with expiration week, book the profit and move on, free up the capital for the next trade. So that's how we'll manage it, just like we've been talking about here in previous weeks with the trade of the week. we'll continue to manage these each week. We'll walk you through how to manage them, what we're going to do. Are we going to close them out, hold them? We'll continue to keep you posted. And then, as always, if you have any questions on these trade of the week positions, you can always leave a comment here in the blog or send me an email directly. Mike@netpicks.com is the email address. Speaking of our trades of the week, let's take a quick peek at our trade from last week. We sold a call spread on CMG. We sold the 440, 445 call spread, and right now it's trading for around $1.50. So we sold this thing. Actually, it's trading for between $1.10 and $1.50. We sold this thing for right around $1.55. Anywhere from $1.55 to $2 was the range that this thing was trading in when we put the trade on. So we've got a small profit here. We still have 14 days left, so there's no reason to close out of the position. With the market stronger here, that's not helping us. But CMG really has never pulled back like we were expecting. So there's nothing to do here. Keep in mind, you don't have to panic just because the market's up strong today. We can hold on to these trades. We can be more patient because the time decay is starting to add up for us in our favor. So nothing to do here. We'll reevaluate it again next week. We currently have a partial profit on the trade, so it's doing what we need it to do. If we could have one of those sessions where CMG is down $10, that would do wonders for us, and we could potentially close out of a profit at that point. So we'll continue to manage this one next week as well. Again, any questions at all, feel free to post a comment here in the blog or send me an email directly. Mike@netpicks.com is the email address. So I'm going to go ahead and wrap this video up here. We'll be back again next week to take a look at our next trade of the week.